I'm going through this, I'm going to make sure I would encourage you put away everything, like literally have your notepad in front of you because everything I'm going to be giving you today is literally write it everything word for word, and this is what you're going to be able to memorize this. So when you go to take your exam, going through this, I'm going to make sure I would encourage you put away everything, like literally have your note in front of back going. As I was going to say is, as we go through this, you're going to want to literally focus on this because I'm going to give you everything you need to know in order to pass that exam. And so let's get this thing on. So, Gina, the way this exam works is that when you walk into the exam to pass the exam, they're going to give you like a dry erase board and a pencil or a marker. And on this notepad, you can't write on it until you start the exam. And we're going to count on you doing that. I don't even want you to look at the questions. I want you to press start on the exam. And then you're going to write down everything I give you. Again, this really only works as long as you know vocabulary. This is the big deal because the stuff I'm going to teach you is key to that help me pass the exam. Oh, no, I'm sharing from the wrong device. Got to get my life together here on this technology. Start broadcast. Okay. So what's going to happen is we're going to walk into this room, and Naja, you're going to put everything to the side. You're going to press start on the test. Don't even look at the answers or the questions. And we're going to write down the things that we know. The first thing I always tell you to start with are the acronyms that I give you. First one is going to be your non-forfeiture options. If I can spell, I wish. I wish I need handwriting and freaking this can spell. Forfeits. You guys get where I'm going with that. Non-forfeiture options. So do you guys remember the acronym for non-forfeit? It's reduced paid up, extended term, cash surrender. Now let's just kind of briefly review this. Reduced paid up is where you're going to take the same money you were already spending on your policy and you said, hey, I'm done paying on the policy. I want to take whatever is in my cash value and I'm going to buy a smaller policy. Whatever my cash value is going to buy, I'm going to buy a smaller policy and my policy is now paid up. The next one is going to be called extended term. Remember, that is the automatic option. If you don't tell the insurance company what to do with your money, they're going to automatically do this. That is where you're going to take whatever money is your face amount of your policy. You're going to take the cash value to buy that exact same amount of insurance, but in a term policy. So that will extend your policy for X amount of years. And then cash surrender, that's when you take the money and you run. You cash the policy out, and whatever you do with it at that point is what you do with it. Remember, if you have actually earned some money in your cash value, you will be subject to taxable income. And that is going to be the growth that you had. So, give an example, Gina. If you paid into this policy $5,000 and that policy grew into $7,000, the only growth you're going to pay on is the difference of $2,000, which is the difference you've earned in interest. So that $2,000 will be taxable as income. Does that make sense? Okay, that's the first one. The second acronym is going to be what is called your dividend options. Remember, dividends are not taxable. They are not guaranteed. Dividend options are meant for those individuals who have been overcharged, and they're giving this money back to you for you to do with. The acronym for that is going to be called CRAPO. Y'all remember what C stands for? And please feel free to unmute yourself and add to the conversation. Y'all remember what C stands for?
Cash.
Cash. Got it right. Whenever you see the word C, it's going to be cash. It's always going to be cash. You want to go? What is R, Stephanie?
Reduction of premium.
Okay, reduction of premiums or reduced premium. That one is going to pay next year's premium. You say, hey, listen, I don't want the money. Just hold on to it and lower my next year's payment. A is what is going to be called accumulation at interest. This right here, Gina, is where you're going to say, hey, listen, hold on to the money for me, invest it, and pay me on it. But any interest you any interest you earn is always taxable. Even if the dividend is not taxable, the interest that it earns does. The P stands for paid up option, paid up addition, and then 1 year term. Stephanie, do you remember the difference between paid up option and paid up addition? Do you remember that? I know it, but so maybe you might have better notes than I do.
I think the paid up option is different from the addition, in which the addition, I think you're like adding on to your policy, and then the option is like an alternative.
Okay. So the paid up option is you're paying the policy off early.
Mm-hmm.
You're going to say, hey, listen, and invest that money and help me pay my policy off sooner. I wouldn't necessarily say investment money. It's just you're paying the policy off earlier. Paid up addition is you're buying more coverage. Remember, paid up option is the automatic option. Automatic option. And Naja, 1 year term is obviously you take whatever amount of money you can buy in that term policy, or sorry, in that policy, buy that coverage for 1 year. Remember, dividends are not taxable, they're not guaranteed. This is money that you were overcharged and they're giving it back to you. Okay, any questions on that? No? Okay. So let's go on to the next one. The next acronym is going to be settlement options. Settlement options. The acronym for that is going to be called CLIF. C is going to stand for cash. I want you to write the word lump sum on that one. L is going to be life income. I is going to be called interest only. That is known as what is called the temporary option. And then the F stands for fixed amount and fixed period. Okay, so let's talk about cash, lump sum. You have accumulated all this money, whether it be in an insurance policy or into a lump sum, and you say, hey, listen, I want the money, cash out, and take the money and leave. Take a check. Life income. This is the form of where you can receive the highest amount of money in when you're receiving your money, Stephanie. So whether it be monthly or quarterly, or however you receive your money, that's when you receive the highest amount of money and monetary value. But the moment you pass away, The money's cut off. The rest of the money that would have been paid out to you, the insurance company keeps. You can't have life income with period certain. So in that example, Gina, if you have a 15-year period certain and someone passes away 5 years into it, the beneficiary would receive the money for 10 more years. The remainder 10 years. Interest only, you just say, hey, listen, I don't know what I want to do with the money. Just pay me the interest. Remember, again, anytime you earn interest, you got to pay taxes. And fixed amount and fixed period, pretty simple. Fixed amount is, hey, I want to receive X amount of money until it runs out. Okay. I want to receive X amount of money and you'll get it until it runs out. Fixed period, hey, I want to receive X amount of money over the period of time. And you're going to get that money for the next 20, 30 years until the time period or the money runs out. Any questions on that? Okay, those are the settlement options. You need to absolutely memorize those. You need to know the definitions of those. You need to know the difference between settlement options and dividends and rec. Because when you are looking through the questions, they'll add those same verbiage within the same question. You're like, hold on, which one goes to which? And if you've written these down, well, now they're not going to confuse you. Okay. Let's go over retirement accounts. I'm going to kind of jump back and forth. Okay. So there's two types of accounts. There's qualified and there's non-qualified. Very simple. Qualified or regulated by the IRS. They're not regulated. They have qualified accounts have tax benefits such as tax deferred growth or tax free growth. There's no tax benefits. Qualified accounts cannot discriminate who gets them. If they have a qualified account at an employer, everybody has to be over here. And qualified, non-qualified accounts, they can discriminate. So give an example. If you have a group of executives and they say, hey, we want to do a profit sharing account with only the senior level employees. Well, at that point, you really can't say nothing because it's a non-qualified account. Cannot qualify, non-qualified. If you pull money out of a non-qualified account before 59 and a half, there is a 10% tax penalty. If you pull money out of a non-qualified account, there's not such as a tax penalty besides the income penalty you're going to pay for it. So because this non-qualified account doesn't have any tax benefits to it, you're not going to get hit with those penalties on that. Okay. Remember, for some qualified accounts, the person has to be employed full-time. They said work at least 1,000 hours a year, which again, when we read that, I'm like 1,000 years part-time. And you must be 21 years or older. Just a very simple thing you want to know. Difference between qualified and non-qualified. Let me know when you got that. Okay. The next piece that we're going to go over are the different types of qualified retirement accounts, Naja. The next one, the qualified accounts are going to be your 401k, your 403b, I'm sorry, your 403B is also known as called your TSA, also known as what is called a tax sheltered annuity. When you see this on the exam, those all mean the exact same thing. You're going to have what is called your KEO plan. You're going to have what is called a SEP IRA, a traditional IRA, and then a Roth IRA. Naja, an employer as a 401k, that is an employer sponsored plan. That is all you need to know about a 401k. It's an employee sponsored plan. You guys remember who can get a 403b?
Teachers,
Teachers. Okay, good. Your
nurses,
teachers. Someone said something else. What else?
nurses, public, or what was it?
You got it right. Nurses,
Public service.
nurses, nonprofits. Remember that? Nonprofit organizations. Those are going to be the individuals who can get it. The next one is called KEO plan. Another name for that is going to be called HR10. So Najee, the HR10, that is for small business owners. Someone who has less than 100 employees. And that 10% stands for 10% ownership in the business. So the next one is called the SEP IRA. The SEP IRA allows you to put 25% of your income away. You're probably not going to be tested on that. 25% of your income annually. Just remember SEP IRAs for small business owners. That's really all they're going to test you on that. They're not going to test your knowledge too much. Let's go into what is called a traditional IRA. The only way you can contribute to an IRA in general is you must have earned income. Remember, that comes from wages, salary, and commissions. Earned income. You must pull your money out by 73 and a half. Otherwise, they penalize you a certain percentage of that. Just remember 73 and a half. That's why don't think too deep into that. Traditional IRA, your money grows tax deferred. All these accounts that I've gone over so far, your money grows tax deferred. You can put up to $7,000 a year into this if you're under 50. And you could put $8,000 a year if you're 50 plus. And those all go the exact same way for Roth IRA, except your money grows tax free. That means if you invest into a Roth IRA, $7,000, and then over the time period, it grows into $10,000, you have a $3,000 that you've earned. That $3,000 is tax free. Does that make sense? All these other accounts are tax deferred. The only one that is tax free is the Roth IRA. Naja, you kind of give me the nod when I can move on. Okay, I want to make sure you get that.
I took notes on that other day. I was just jotting stuff down.
Okay. Well, I want to make sure that you even though we've written this already, you want to write it again because the sharpest mind is no match for the dullest pencil. When you rewrite this over and over again, I'm literally giving you the cheat sheet that I want you to write this crap down 15, 20 times over the next few days as you're preparing for your exam because you're like, oh, I know this crap by now. That makes sense? So any questions on retirement accounts? Nope. Okay, let's go into annuities. What do we know about annuities? Annuities are a life insurance contract. Remember that. Annuities are life insurance contract. Annuities are designed to help you build think of it like a pension for your whole life. A pension's meant to pay you for the rest of your life, but it's an insurance policy. It's not a life insurance policy, but it's an insurance contract. So two types of annuities. You have fixed and you have variable. If I can draw a T-bar for these two, I would. What's the difference? Fixed, there is a guaranteed interest rate. The insurance company is going to guarantee the client a guaranteed interest rate. Variable, it's a non-guaranteed interest rate. When you put your money into a fixed annuity, the insurance company combines your money with theirs. So they put your money and their money into what is called a general account. When you invest into a variable annuity, they're going to put your money into a separate account. They say the annuitant or the policy owner is taking the risk. We're going to keep our money over here and good luck with your money over there. And a fixed annuity, it does not keep up. What the freak am I writing there? It does not keep up with inflation. Because generally this is a very low interest rate account. Variable accounts historically does keep up with inflation. And again, inflation just means cost of living, even though I think we're all experiencing inflation these days, right? Now let's talk about this. And fixed annuities. This is what is called suitable for elderly. The word suitable is you do the right thing for the person. This policy is safe for this client. Variable annuities are not suitable for elderly. Unless the elderly person is saying, hey, I'm not going to need this money. This money's for the grandkids. We can invest it long term. You'll never have an elderly person invest into a variable annuity. Last thing we're going to touch on, in order to sell a fixed annuity, you need your life insurance license to sell your fixed annuity. For your variable annuity, you need your life plus your investment license. Okay. Stephanie, how we doing? We're good? Everyone's good on this page? Okay, perfect. So let's talk, we're going to stay on the topic of annuities. We just described how the account is going to fluctuate. Is it fixed or is it a variable annuity? Now let's talk about how you can pay into an annuity. The way you pay into an annuity, I mean the frequency, is you're either going to pay single premium or you're going to pay flexible premium. Remember, single premium is lump sum. You're putting a lot of money up front. And flexible premium is multiple payments. Now, this describes the frequency and how you're funding the annuity. The next thing we want to talk about is how soon can you start touching the money? So in single premium, you can have single premium immediate annuity, which means you can touch the money within 12 months, or you can have deferred annuity, which is after 12 months. In flexible premium, you can only have flexible premium deferred annuity because you have not made enough payments to where it would allow that annuity to mature and actually grow into something. So that talks about the frequency of how you could pay into it and the frequency of how soon you could touch it versus how you could pay into it. Let's talk about the way of how the money accumulates if you were to close out of the annuity, and how does it look when you start receiving money. So I'm gonna just go over to a new page just because this one kind of gets kind of messy. So I always like to picture an annuity like a mountain. This time period, you're accumulating your money. At this time, Gina, the money's yours. You could cancel the contract at any time. But if this money grows into something, the insurance company has what is called a surrender charge. And if you've earned any interest on your money, they tax the money by LIFO, which means the last dollar in is the first dollar out. So LIFO, last in, first out. There is also, and you want to go back and read this, it's called FIFO, first in, first out. But this says the last dollar in is the first one out. So if you decide to pull money out here, this one's going to be based off of LIFO. So Naja, let me just paint a picture for you. You're paying into this annuity. You're like, hey, listen, I want to make sure this money I don't outlive this money. So when you're paying and you're funding this annuity, that is called the pay-in period. That is also called the accumulation phase. When you enter the accumulation phase, your money is converted to what are called accumulation units. The value of these accumulation units can fluctuate based off of how the investment is doing. Remember, this money is your money at all times until, Gina, you enter the very top of the mountain, which is years later, and you say, hey, I want to start receiving my money now. And you enter, so the pay-in period becomes the payout period. Also known as the annuitization phase. Also known as the annuity phase. Also known as the liquidation phase. Those all mean the exact same thing. The payout period, the annuitization phase, the annuity phase, and the liquidation phase. All it simply means is that you are going to start receiving your money, and your accumulation units are now converted to annuity units. So you are going to start receiving your money. So your money, you think your account balance will drop over time, depending on how the investment went and how often you're pulling from it. Does that make sense on how that annuity works? You remember when I covered settlement options earlier on the first page, or the first or second page, we talked about settlement options. That is how you start to receive money from the annuity. That right there is all you need to know about annuities. So if you can memorize this and you listen to this audio over and over again, I'm literally giving you everything you need to know about annuities. Okay, we're good? All right, next thing we want to talk about is term insurance versus whole life. What are the differences between term and whole life? Term is known as temporary coverage. Whole life is known as permanent. Term insurance is known as called pure insurance. So if you see that word on the test, it says, which of the following identifies pure insurance? Bam, term insurance. Whole life insurance, it has the non-forfeiture options. In most term insurance, the premiums are leveled. Most whole life premiums are leveled, meaning they don't change. Whole life, it matures at 100 years old. It builds cash value. Those are the three major differences, or 4 or 5 differences. Remember, term insurance has no savings account. Okay, so this is the skeleton. We're going to go over the 4 different types of term insurance. You ready? Okay. First term insurance is called level term, which means the face amounts and the premium remain level during the lifespan of the policy. So whether it's 10 years or 35 years, that policy will remain level over that time period based off of the policy. All right. The next one is going to be called decreasing term. Next to decreasing term, I want you to write the word mortgage. This one should identify close to a mortgage, because one thing about a mortgage is that the balance should decrease every year, but your premium payment is going to stay the same unless you refinance. So over here, the face amount decreases and the premium is leveled. So that means in year 20, if you're still paying on this policy, you have the opportunity where you're probably still paying $100 a month for lower coverage. But the reason you get a decreasing term insurance for the sake of the exam is for a mortgage. The next one is going to be called annually renewable term. Gosh. I need to renew this handwriting, bro. I feel sorry for you guys got to actually read this crap. So annually renewable term, also known as ART, annually renewable term, for the sake of the exam, is level premium. It's level during the period of time that it is in force, even though it's only in force for a year at a time. Annually renewable term, the premiums increase every year. Do not let that confuse you of why the premiums are not level. It renews every year, so the premium is going to stay level during that period of time, but every year it's going to increase. And the point of this is there is no medical required to renew. All right. Stephanie, any questions? Nope. All right. So the other type of term insurance is going to be, this is not going to be a standalone insurance. It's generally a rider, but it's called increasing term. Again, this is a rider, which is an add-on to the policy. That generally, Naja, is going to be, it will allow you to increase your coverage every few years without going through any medical process. Obviously, your premiums are going to go up based off of your new coverage, but there's no medical required. And that's the important piece of it. That's why that's a good feature for that. You might see what is called a return of premium term. This just simply means that again, it's going to be a rider. They're going to say, hey, if you have what is called a return of premium, and if you don't die within X amount of years and you're still alive on this date, we're going to refund you your money back. For the sake of the exam, it is 25 to 50% more money for that coverage. And that is all we need to know about term insurance. All right, so any questions on this so far? Nope. Okay, cool. Let's go over to the next portion. It's going to be your whole life policies. Remember, your whole life insurance, permanent insurance, the three things that are guaranteed in whole life are your non-forfeiture values, the death benefit is guaranteed. So as long as you pay on this, it's guaranteed. Most premiums in a whole life policy are leveled. And then this matures at 100. That is the skeleton of all whole life insurance. There are going to be some different nuances, but for the most part, this is what we're going to go through. So the first type of whole life is going to be called your straight life. Straight life, also known as traditional whole life. That is also known as ordinary whole life. These definitions is what I just described. Straight life stays premium, traditional, ordinary whole life. Those are all the same name for the same type of whole life I just mentioned. We're about to jump into the fancy types of insurance whole life policies. First one is going to be called universal life. Now, what do we know about universal life? I want you to write this down. It is ART plus cash value. What do we mean by ART? ART stands for annually renewable term, which means the premium goes up every year. The cost of insurance goes up every year in this. And it builds a savings account. When you are paying into a universal life policy, you have two options to pay. You have your standard premium and you have what is called your target premium. So, give an example. Let's just say we have a $100,000 whole life policy. Our standard premium is $80 a month. And our target premium is $170. This right here will keep the policy in force for now. But we are encouraged to overfund the policy up over the years with $170 because years down the line, that premium is no longer going to be $80. It's going to be $120, $130, $140, $150. And so that extra premium is going to keep paying the difference down the road. Does that make sense? It's like you saving money under your mattress for a rainy day. Oh, if I need to pull from it, I can't. That is what's going to keep the policy in force when the premiums go up. Now, Gina, what happens is they're going to pull that money from your cash value to pay the difference. But let me ask you a question. If your cash value eventually reaches zero and your new payment is $170 and you're not willing to pay for it, willing to pay that new premium, what happens to the policy?
Would lapse.
It's going to lapse, absolutely. So what happens is you paying into this policy for years after years after years, and you're hoping that cash value is going to be there. But if it's not there and you're not willing to pay that new premium, your policy implodes on itself. Again, for the sake of the exam, they're not going to ask you that, but that's how those policies work. Now let's talk about the last part of universal life. So there's option A or option A or option A, one or A, gosh. I want you to write the word corridor. That's all I want you to write. If you see the word corridor in the question, that's your answer. I want you to freaking asterisk that sign. I'm telling you, that is an easy question for you to get right. The other option is option 2 or B. This one allows the beneficiary to receive the life insurance and the cash value if the insured passes away. This one is going to be your more expensive policy option. If you see when you're in the field later, once you're licensed, and someone sees, oh, you see option 2 or option B, that's generally the more expensive one they charge. And again, not a bad thing. It's just what it is. Any questions on universal life? No? Okay. That is all you need to know about universal life insurance. Now, it does have a minimum death benefit. It has those minimum death benefits. Okay. The next one we're going to talk about is variable life. Remember how I mentioned to you in that T-bar between fixed and variable? I want you to remember everything we said about variable annuities applies to variable life insurance. Stephanie, do you still have your notes from variable life that we took earlier last week? The different nuances of it?
I believe I do, yes.
Would you mind pulling them up? Just to refresh
Sure.
my brain. I'm not looking at it right here. I just don't want to misspeak.
Variable life combines whole life with the flexible premium of universal life. An investment component of variable life flexible premium, increasing/decreasing the amount of insurance, cash withdrawal, or policy loans. That's the variable universal life.
I want you guys to make sure you go back there, and I just because for the sake of you, I don't want to misread that tonight. Go back and just get all the little different nuances of what I talked about earlier this week on variable life. Just remember, the main part is the premium can fluctuate. The investment account will fluctuate based off of the investment. I think the premium's got a standard premium that you'll pay though. It does have a minimum death benefit. If the person passes away, they will only get the life insurance, not both. Because it is a variable account, you need your life insurance and your investment license to sell this. You are regulated by the FINRA, Securities Exchange Commission, and the Department of Insurance when you're selling this. This is a multi-variable product. The other one that we want to go over, just for the sake, and Stephanie, if you can bring this back up, it was universal variable life.
I'm sorry, I took a lot of notes.
No, that's fine. No. That's why I'm coming to you. I know you took a lot of notes.
I have universal life, universal and variable. One moment.
Look at that, Naja. You're gonna be licensed in South Carolina. Gina's gonna be licensed in North Carolina, and then Stephanie up in Jacksonville. Let's go. I'm looking at 3 different states, cities over here. The states. Come on. Well, as you're looking for that, guys, just go back and review what variable universal life is. It's not much more different than universal. It just has got a different couple components with your securities license and such and such. The last 2 options we need to look at is called limited life or limited pay life. The 2 options is 20-year pay and then life at 65, which again, it means this, and there's single premium, forgive me. There's 3. So 20-year pay, you pay for 20 years. Life at 65, you pay it until 65, and single premium, you pay your whole policy up front. I can't even imagine how expensive that would be. But you're paying your policy up front. Those are what is called limited pay. You want to go back. There's not a lot of different nuances. If you remember all the basics of traditional whole life, just add the different component of the time frame you're paying into the policy. And once you pay the policy for that period of time, you're done paying on it. The other one was joint life and then survivorship or joint survivor. Joint life is first to die. Survivorship, second to die. Only other thing you want to know is that they do the premium based off of the average age of the people covered under the policy. Again, as long as you have all the other specifics of the policies, we're good to go. All right, any questions on this? Folks, we went through mostly everything you need to know about the exam. The only thing that we did not cover tonight was your riders, policy provisions, and rights and your laws. You remember your riders? Your riders are going to be what are called your waiver premium. I don't need it. I'll break out of this piece right here. Naja, the piece that you want to go back over, and you actually want to write these definitions out. You want I tell you to look at that glossary like crazy because you know this. I promise you, you're going to pass it like crazy. You want to look at your riders, like your waiver premium, your terminal illness rider, your disability income rider, your pay or benefit rider. You want to know the definitions of those. The other thing you want to know are your exclusions. Why would the policy not pay out? And that's going to be based off of aviation, military service, or war terrorism, your occupation. Other things you want to review are your beneficiaries. Your three types of beneficiaries: your primary, contingent, and then that third one is tertiary, whatever. You want to look at the difference between revocable beneficiary, irrevocable beneficiary. For the sake of the exam, Naja, I'm going to ask you, hey, you know what? Let's make sure we're studying early in the daytime. I got to tell you that because that part's going to be the important piece, because if you are reading this super late at night, it ain't gonna stick with you. But I'm telling you that you want to go back and listen to this audio over and over again. Remember the pieces that we couldn't really touch bases on with the laws and regulations because they were different for your state. But for the most part, if you can lock down everything that we talked tonight, along with the provisions, riders, exclusions, and your laws and regulations, you will ace. Yeah, you will come close to acing that exam. Any questions so far, or things we've gone over so far tonight? Y'all feel good? How y'all feel about getting together tomorrow to knock out that practice exam? Y'all good for that?
I don't know if I'll be able to start night shift.
We will miss you. Gina, you good for tomorrow night?
Yeah, it should be fine. Yeah. What time?
I say 9 o'clock tomorrow. Just be safe for everybody. That'll give me enough time to finish up my meetings and be back over here.
Yeah.
That's good. Okay. Okay. Yes. Well, good. Well, wonderful. Stephanie, shoot me a text right after this, and we'll coordinate for tomorrow if that's even needed still. And Gina, I look forward to connecting with you tomorrow. Naja, if we do not get to see you tomorrow, we will miss your face. And then yeah, we'll go from there. But enjoy your night, ladies. Appreciate your time.
Bye bye.
Thank you.
Yeah.